In learning objectives 4 and 5, we're going to talk about how to prepare an income statement and cost of goods sold along with the cost of goods manufactured. Cost of goods sold is what we would find on our income statement, and cost of goods manufactured is the cost of inventory on finished goods inventory on our balance sheet. And we'll also take a look at how we can determine the individual cost per item in a manufacturing company as well as in a service organization. So how do we determine the cost of manufactured products? On the income statement, and remember on the income statement we have sales less cost of goods sold to get to gross profit. Well, basically what information we are using here is that the finished good inventory account should include the cost of goods manufactured. And we will use the total cost of finished goods manufactured divided by the total number of units that we produced to figure out the cost per unit. And if we sell 20 of those units, then 20 times the cost per unit is our cost of goods sold. We'll see this in detail as we move forward. And so if we've sold the product, we want to subtract the cost of goods sold to determine gross profit. And so in the gross profit side, we're analyzing how profitable a company has been in manufacturing and selling their inventory. But there's also another portion of the income statement called operating income. And the operating income is our gross profit less any other expenses tied to the basic daily operations of our business. Sales, commissions, insurance, human resources, accounting. Right? So we're going to look at all of these in a little more detail as we move forward. When we're calculating cost of goods sold, this is a little more simplistic income statement than what I showed you earlier in the Excel spreadsheet using Smart Touch Learning, which is a project that is, or a business that is carried out throughout your text and manufacturing tablets and the software that goes on those tablets. We have our sales revenue. And we want to subtract from our sales revenue, which sales revenue is reduced by any returns and allowances or discounts. So we have our net sales revenue, and we want to subtract cost of goods sold. But how do we come up with cost of goods sold in order to get to gross profit? Well, there is a formula that we can use, and if you've paid attention earlier, you will see that we're using this formula over and over again. First of all, if we're looking at cost of goods sold, we cannot sell it unless it is finished. Okay, so if we look at beginning finished goods inventory, how much money did I have tied up in finished goods inventory to begin with? In this particular situation, it's zero. We're probably a startup company or a just-in-time manufacturer. And so if we take into consideration the material, the labor, and the overhead, the total cost of goods, total cost of finished goods, we should put finished goods manufactured in here, then I have manufactured $660,000 worth of finished products for this period. And if I know that out of the $660,000 that I have manufactured, there are only $60,000 worth of those still in ending inventory, what happened to the rest? I sold them. Okay, so if I had $660,000 worth of tablets available for sale, only $60,000 are left in ending inventory, then I sold $600,000 worth of tablets. This is a product cost that has now moved off of the balance sheet onto the income statement. Now the $600,000 in cost of goods sold is related to the $100,000 in sales. So my expenses for inventory match my sales of inventory. So now I have gross profit. And if we drop down beneath that, we can see an additional example of those period costs that we talked about. I have gross profit of $400,000, but there are other expenses that are related to the office. We can see wage expense, rent, insurance, depreciation on office equipment, not manufacturing equipment, supplies that are used in the office. So all of the expenses that we see reported in this particular area, the selling, general, and administrative expenses, were expenses that were not tied to manufacturing my inventory. These were expenses that were directly related to selling and moving my product and servicing my customers after the manufacturing process had already taken place. But if I take my gross profit and I subtract those total selling and administrative expenses, I come up with operating income. So I can see not only did I sell my product for a profit, $400,000, I still have a profit of $159,000 after we take into consideration all of those selling, general, and administrative expenses. Now remember the interest expense that we saw in a problem earlier? Once again, most of the time, just your daily management and supervisors don't have control over how the CEO or the top executive of your organization has decided to finance those assets. So if we've borrowed and we're paying interest expense, it's really not, this is a financing expense, and it's usually listed in other revenue and expense on your income statement. So when we back out interest and tax, we come all the way down to our net income. But you can see the importance of determining what is my cost of goods sold and how much profit do I have after selling that inventory? How much profit do I have after the period expenses that we see here have been applied? So when we're calculating, we need to know the cost of finished goods manufactured before we can figure out the cost of goods that we have sold. Right? And as it says, these costs are determined from activities that have taken place in the past. We said this earlier. We're trying to account for them. And we can kind of follow this flow. If we had T's in the middle of these boxes, which we don't, but if we did make these T accounts, all right, you could actually see that when I purchase raw materials, I debit my raw materials account. Okay, so that's what's coming in. This is my debit. As I move those raw materials into work in process here, okay, I would be crediting raw materials and moving them into work in process. Work in process combines the labor and the overhead. So on my balance sheet, I see the total cost of raw materials that I have purchased. And as I move those raw materials out and into the production process, the raw materials account will decrease. And I will see work in process increase for the amount of materials that have come in, for the labor that has come in, the manufacturing overhead. Now, once again, if this were a T account, we could see, we'd have to move this over here as a debit instead of a credit. All right, I know this is sloppy, but let's cover up here. As the work in process is finished, okay, I've put my direct labor, debited my work in process for it. I debited work in process for overhead and for raw materials. But as the product nears completion and is complete, we will credit work in process and move it over to our finished goods account. Once again, if we had a T account here, then the movement from work in process into finished goods is a debit. They stay in finished goods inventory as an inventoriable cost until I do what? Until I sell them. As I sell them, I would credit finished goods inventory and move them out, as the arrow says, over to cost of goods sold. So how do I know what cost ends up in cost of goods sold? If I know the total cost of finished goods inventory and I know the total number of units that I produced, then total cost divided by total units tells me what it cost me per unit. I may have manufactured 1,000 units, but I only sold 900. So we only move out of finished goods to cost of goods sold the cost of the units that we actually sold. So here we can see on our income statement, sales less cost of goods sold is gross profit. We see these words again. These are my product costs. Why are they product costs? They came off of my balance sheet. They were inventoriable cost. Notice the period cost, they were never, ever, ever over here on the balance sheet per se. Okay, these are costs that were directly related to operating the business. They are related to operating income. Now, when we calculate cost of goods manufactured, to give you a little detail here, let's think about, I want to know the total cost, and I wish they would add the phrase here to make it a little more understandable. This is the cost of, let me see if I can write again with this, the cost of finished goods. I look like I'm in kindergarten. Sometimes I feel like it. Okay, but you understand what I'm trying to tell you. I want to calculate the cost of finished goods manufactured, because the cost of my goods that have not been finished are sitting in work in process. And the cost of raw materials that have never been used are sitting in raw materials. So how do those all tie together? We've got this cost of goods manufactured statement. So what happens is I begin with what was in work in process at the beginning of the period. All right, I had $80,000 worth of what? Work in process inventory that was not complete yet. So in order to complete this work in process, I had to add some materials, and I had to add some labor, and I had to add some overhead. All right, so material, labor, and overhead are the costs that I'm going to incur to finish this beginning work in process. All right, well, labor is pretty easy. How much labor did I incur? Here it is, $169,000. For this problem, overhead's fairly easy. They're simply telling you this is what it is. Indirect material, indirect labor, depreciation, plant, and utilities. All right, so these are our indirect costs. And in most cases where you guys are in this particular class, it's going to be given to you. Okay, in later classes, we'll try to calculate how we actually allocate the exact amount of overhead to our production process. But here, they've just told you what it is. They told you what labor is. So what we have to work on is materials. How do I come up with my materials number of $355,000? Well, we back up. If I had 70,000, we're manufacturing, let's say, the tablets that is illustrated in your book. Smart Touch Learning tablets. If I had 70,000 in raw materials inventory to begin with, and I purchased another $350,000 worth of raw materials, and they're trying to show you, once again, freight in is always part of the cost of your inventory. So if I had 70,000 in raw materials, I purchased another 350 in raw materials, then I had 420,000 of raw materials available for use. If there are only $65,000 worth of raw materials left at the end of the period, I had 420 available, but only 65 were left at the end of the period, then I used $355,000 worth of raw materials. Okay, so it takes us back again. We're kind of backing into it. I had 80,000 in beginning work in process that needed to be finished. This inventory needed another $355,000 in material, it needed $169,000 in labor, and it needed $83,000 worth of overhead. So what we know is that I started with 80,000 in unfinished goods, work in process. I added another $607,000 worth of what? I think I can hear you. Material, labor, overhead. We all have it, right? So if I started with 80, I added another 607,000. I have or should have available, notice what they call it, cost to account for. I have added $687,000. This is what has taken place in my manufacturing process for this period. 80,000 to begin with, the 607,000 I have added this period. That gives me $687,000 worth of cost of goods manufactured. However, what happens if we don't finish everything? Notice at the beginning of the period we had some inventory that wasn't finished. And also at the end of the period, we have some inventory that has not been finished. So if we subtract, right here, that's why we see it in brackets, I've got $687,000 in my production process, but $27,000 of my inventory is not finished. So I cannot count that as the cost of finished goods manufactured. So the cost of what I have actually finished is only $660,000. If I know that I manufactured 20,000 units, then we know that 660,000 total cost of finished goods divided by the number of units that I actually finished will give me my cost per unit. Go back, review this, look over this as many times as you have to, because this statement is going to move with us throughout the rest of this semester. And the same process is going to move with us. What did you start with? What did you acquire? What did you have left at the end of the period? The rest has been used up. Okay, we're going to do this over and over again throughout the semester. So try to get your brain wrapped around those thoughts. And this is just a different pictorial illustration of what we just talked about. These are the materials that I had to begin with. These are the materials that I purchased. This is what I have available for use. If you subtract ending inventory, then this shows you how much material I have actually used. This raw material has been moved into work in process. Work in process also incurred some labor. They incurred some overhead. And when I know, this goes back to our cost of goods manufactured. Okay, the same elaborate formal statement that we see here. Okay, with lots of markings. We can also see it in a very simple form right here. This is what I started with that wasn't finished. I added materials and labor and overhead. So these were the total cost I had in my manufacturing process. I subtracted what wasn't finished yet, and this is my total cost of finished goods manufactured. But I wouldn't move this whole $660,000 over to the income statement as cost of goods sold. I am going to move this $660, like our arrow says right here, over to finished goods to show that, hey, I have $660,000 worth of finished goods inventory on my balance sheet. And if you think about it, if you're a banker or you're a creditor or any other kind of analyst, and we have pledged our inventory as collateral, okay, can I borrow from you using my inventory as collateral? Well, think about it if you're the banker. If you had to foreclose on this company, would you rather foreclose on finished goods that you could possibly sell or move out into the market? Would you rather foreclose on inventory that's halfway complete? Or would you rather foreclose on raw materials that haven't been used yet? Okay, so being able as a creditor or an investor or an analyst to understand the value of a company's inventory in these three different states is very important to people who are making decisions about your company. All right, calculating the unit product cost. Like we mentioned, if we know the total cost of goods manufactured, and we divide that by the total number of units that we produced, then we know that our cost per tablet is $300. What I am going to move out of finished goods and into cost of goods sold is the number of items, not that I've manufactured, the items that I have sold. So the number of items that I have sold, 2,000, times their cost is what will actually move over to cost of goods sold. Do we need to back up? We manufactured $660,000 worth of tablets, but I have only sold $600,000 worth of tablets. I still have 60,000 finished goods in inventory ready for sale. Okay, this is exciting stuff. This is useful information when you're trying to help a company make decisions. And so if we look at this in a homework problem at the end of your chapter, if we look at our sample problem 1811, it asks you to compute the cost of goods manufactured. All right, let's just move through this quickly since you've seen it in several different pictorial illustrations in our lecture here. If I want to know the cost of goods manufactured, what do I start with? Raw materials? No. Direct cost? No. What am I starting with? I want to start with beginning work in process inventory. Okay, so if you'll notice, here's our work in process inventory. They told us that we had 7,000. So I know that I started out with $7,000 worth of product. What are we doing in 11? We're a golf company. Okay, and so I have $7,000 worth of inventory that hasn't been complete yet. I can do nothing with inventory that has not been completed. So we add some materials, and in this case they just gave it to us, 12,000. We add some materials, we add some labor, we add some manufacturing overhead. Now, and they're simply giving us this so it kind of makes it easier for us to do here. But what are the costs that we have to add to work in process to finish our goods? Material, labor, overhead. Not trying to be repetitive, I just want this to sink in. How do I calculate the cost of goods manufactured? Start with what is in process. Add to what is in process material, labor, overhead. And if you'll notice, if I were to ask you what were the inventory costs that you incurred this year, it's not $54,000, it's only $47,000. The $7,000 you incurred last year or in a prior period, prior month, prior quarter, but I have added another $47,000 worth of manufacturing cost to my inventory, which gives me a total of $54,000 in my inventory. Finished or incomplete, $54,000. But once I check and I know that I still have $5,000 worth of inventory that is in process, incomplete, then that means I have actually spent $49,000 on the cost of goods, cost of finished goods. Okay, I'm just going to use FIN here. This is the cost of finished goods manufactured. And if I know the total number of goods that I have produced, 49,000 divided by the number of units I produced gives me cost per unit. And when I know how many items I've sold, I multiply cost per unit times what I've sold. And then where does this go? You guessed it, cost of goods sold. Okay? Now, I'd like for us just to wrap up quickly on Objective 5. We also want to know the cost per unit for a service company, not just manufacturing company, but the concepts are the same. If you know that you incurred a total of $3,900 in total cost for a particular service or consulting engagements that you have performed, you're an orchestra, you're a sports team, you're a law firm, you are an entertainment company, you're Disney World. Okay, what are the total costs of your services? Divide that by the number of services that you've provided, and we know that our cost per service is $2 per service. Okay, so the concept is the same, but the total cost of our service and the total cost of manufacturing our product are delivered in two completely different ways.